Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. If you've been following along with these market reports, you'll know that I leave my lines on the charts from the previous week so you can see how the forecast worked out. And last week I drew this diagonal line just like this. Remember, last week none of these candles were here. We just had this green candle and this had not yet happened. Now we have a shortened trading week this week, and so we only have 4 trading days. But look what we have here. We have a drop in volume every single day of the week while the price was going higher. Now, if you have a copy of my trading checklist, you'll know that a drop in volume on the way up is bearish. It tells us that the bulls are running out of momentum there. And in addition to that, we have this small little candle known as a spinning top. Look down below, you'll see that there's a fairly wide divergence between the K and the D on the stochastics. And while the CCI is not overbought, it's actually starting to hinge. I'll magnify that for you so you can see it's starting to turn a little bit to the side there. So what does that mean for next week? Well, now that we've hit all of our targets, I'm going to redraw these lines. Now remember, next week begins what's called the year-end rally or the Santa Claus rally. Now, according to the Trader's Almanac, the year-end rally is measured from the last 5 trading days of the year and into the first 2 trading days of the new year. And historically, we're looking for a positive day each and every one of those days for 7 days, with a return of about 1.4%. Again, this is according to the Trader's Almanac. There are some folks that say, 1.3%. Some are measuring just the S&P. Some are measuring the diamonds. I mark this against the diamonds. I always have for the past 40 years. And so what we need to see are positive days. If we do not see that year-end rally or Santa Claus rally, then guess what? That's taken as a failure to rally. And we could see a sell-off for the beginning of January and into the first and second week of January. So what we have here is an area of resistance right there on that drop in volume. While we might go a little bit higher on Monday, I'm forecasting that we're not going to sustain 7 consecutive days of green candles. Why? Because we already have a stale green light here with 5 candles all green in a row. And so it's highly unlikely that we're going to go for 12 days total of green. So I think we'll go a little bit higher, but then I think we're going to wind up right back to this moving average right here, the 20-period moving average. So my forecast for the end of next week is going to be a downside on IWM of 218.66. You see that in the box right there, 218.66 right up until the end of the year. Again, that's the Russell 2000. Now, if I switch to the diamonds, you'll see that my forecast lines were hit precisely. Remember, this was a 2-week forecast that had gone on from right here from December 10th. And last week, I drew this line saying we would most likely drop early in the week and then rally towards the end of the week. On Monday, we dropped a lot further than I thought, but we still dropped. We hit that target on the downside of 350.175, and we filled this gap all the way down here. You see that? So now we had a reversal from that gap fill point, and my upside target was 356.25, and that was hit yesterday. All right, so now that all of those targets are hit, let's analyze the diamonds. Well, again, we have a drop in volume over these past days. We still have momentum going here on the CCI. It's still heading up. The stochastics is still heading up. I think we could go a little bit higher again in the diamonds on Monday, but I think it's going to hit resistance right here and come right back down. Why do I think we're coming back down? Well, look down below. You have a gap that was left today and a gap that was formed on Tuesday. So remember, those open gaps below the market act as price magnets. So again, to reiterate, my upside target for Monday is going to be upside on the diamonds at 361.27, And then for the rest of the week, right up until the first week of January, I think we're going to come back down to 354.97 on the diamonds. Now let's look at the Qs. This is the tech sector, QQQ Trust. Again, my lines were left from last week. I said we would move up. With my end line target for the Qs was 390.21. We hit that perfectly yesterday. Went a little bit further today. But again, look at that drop in volume. It's very pronounced. Drop in volume each and every day for 5 days with that long stretch of green candles, known as a stale green light. We're long overdue for a red. Again, now that those targets are hit, I'm going to erase those lines and draw my new lines. If you look to the left right here, you'll see that there's a high resistance area right there that I think will hold. Again, I think we'll move up early in the week and then start to sell off later in the week. So let me draw my more permanent lines there so that they'll be saved for next week. Again, an upside price target for the Qs right there at 399.41. And then by the end of next week, right back down to the moving average, downside target of 391.14. All right, so that is for the Qs. So what does that leave us with? Well, we have the spiders, and we're still going to have to talk about the VIX. Last week I said we would go up and then pull back to hit this downside target. Guess what? We did that actually in reverse. We dropped to the downside target first on Monday, and now we're seeing the rally. So we hit both those targets, not necessarily in that order, but look what we have here, a gap up on this candle for the spiders. Again, now that those targets are hit, let me erase these and redraw. You have a long shadow above that candle. It's not quite a shooting star, but this is going to be a resistance area right here that we'll have to see whether or not it holds or breaks out. It might actually violate that by a small margin, but then I think we'll come right back down. So I'm still going to mark this to the upside on Monday, possibly Tuesday. And again, I'm expecting a pullback to the moving average right around 462.27. Now that brings me to the VIX. Now remember, last week I said we would most likely pull back on the VIX. That's why I drew this little hash mark right there. And then I said ultimately we would rally after that. Now remember, my guarantee from a while back was that that gap would fill. That absolutely did that on Monday, and then we started to pull back. So I'm keeping this in place as the next resistance area right here. I'm just going to move that on over to the sidelines and draw it just like this. I think the VIX is going to move right back up, and I'm going to give a long-term forecast on this that's going to go well into January, actually January 23rd. All right, so we have a long stretch of red on the VIX. That's a stale red light. All right, we hit these downside targets here, so I'm going to remove those. This is an opportunity for option traders when the volatility index is this low. It's an opportunity for option traders to be legging into or initiating calendar spreads, being that the implied volatility is so low. We could lock in long-term volatility on the low end on the long side, and then as the volatility continues to go up, we could roll our short positions and continue to make money by bringing in that cash. So I'm bullish on the VIX. That is a big deal. You should keep that on your watch list as a leading indicator. I do see some green in the near future for the VIX. There is a very slight gap right there. It's hard to see. I'll magnify that. But there's a very slight gap right at the moving average. So again, I can give you another guarantee that that gap will fill, but I think that's going to be a no problem for the VIX actually over time. So if you're an option trader, you might want to look at the long-term calls on the VIX or possibly some puts on the S&P, whatever it may be. Our option traders are in diagonal put spreads on all the major markets. And we are looking forward to a very productive 2022. Remember, the general markets are expecting this year-end rally to yield a 1.4% gain in the next 7 trading days. I'm actually going to go against that. I don't think we're going to get to 1.4%. That's going to be about another 500 points to the upside in the diamonds, but we have to keep each candle green for those 7 days. I think that's going to be a tough one to match or at least achieve. Again, look that up. Trader's Almanac, year-end rally, aka the Santa Claus rally. And with that, I'd like to wish everyone, your families, your friends, your neighbors, a very Merry Christmas, and I'm looking forward to speaking with you next week. So long.